Hey everybody, it's Terry YUEDE back, and we're getting ready to get our presentation started tonight. I'm here with my brother Keith.
Hello everybody.
And tonight we're really happy to welcome one of our great clients named Chris Winterhalter. He's going to give us some tips as far as how he's been successful with real estate investing through the years,
Particularly in St. Louis.
Yeah, in St. Louis. So Chris, we want to welcome you to the presentation tonight.
Thank you very much, Terry and Keith, and I appreciate you having me on the call tonight.
Now, Chris has been investing in our market since 2008, something like that, 2007, Chris?
Yeah, 2008, just right around the crash.
Okay.
And yeah, right after the crash happened, that's when I got started. Basically, 3 properties started it all.
And Chris has really had some good success in the market. He's done a lot of really neat things, including multifamilies, flips. He's done some wholesaling. And we're going to be talking a little bit about his business. And he's going to give some tips to investors out there. And whether you're a seasoned investor or you're maybe just starting into the business, it's always good to listen and see what others have done, to help make their business run smooth and well.
There's no doubt about it. With all the stuff that's out there, the late night stuff, the making money in real estate is easy, that type of thing, it's really good to get the perspective from someone that actually does it for a living and someone that's in the trenches and maybe realize that it's not really all that easy.
And Chris is actually a professional real estate investor, so he does this for a living. Chris is also what you call a venture capitalist. So he's going to probably talk a little bit about that tonight. I don't want to steal your thunder at all, Chris, but we'll get to the Q&A here shortly. Keith and I are going to get things started tonight. We're going to be talking about a real estate recovery.
Believe it or not.
Yeah, that some people think it's here. We hear a lot in the media about what's going on with the recovery, and this is just a recent, actually it's the April 2013 issue of Money Magazine, and you can see right on the cover, housing is back.
Look at that, housing is back.
Yeah, pretty house, blue skies, everybody's happy. But is that really what's going on?
What we think in the research that we've been doing so far this year, there's no doubt that the market is better.
It is.
It's improved. I mean, there's no doubt, and we have a lot of statistics to prove that in the presentation tonight. But there's definitely a dark side, and we're going to be talking about that a little bit too. When comparing the market now to the way that the market was before the crash, there's more foreclosures. The financing is still a little bit tighter. And the sentiment might not be what it was at one time, but there's some good, some bad, and we're gonna get into some of that information tonight.
So maybe a little bit of a rocky road as far as the true recovery. Just real quick, a little bit of housekeeping before we get started tonight. We want to let everybody out there listening know that all of our webinars, as well as our podcasts, are all recorded. The webinars go on YouTube, so you can replay this, you can share with friends, you can revisit the information. Also, if you're a member of the iStore, the iTunes store, you can go in and you can download all of our webinars, all of our podcasts for free. So we want to invite you to do that. So let's get right into our market watch for Q1 2013.
Hey, Terry, Keith, got a quick question for you. Did Money Magazine send that cover to every homeowner in the U.S.? Kind of like as an alert, like housing's back, everybody?
You didn't buy, you better buy now. I like it. That would have been smart.
That is a good idea.
Well, that's one thing that's interesting, and I meant to mention that, is actually the consumer sentiment whenever you're talking about real estate has been so bad for the last couple of years. And that really had to have been one of the factors why the recovery took so long and is taking so long. I mean, even personally for me, I'd go to like a family gathering or I'd meet new people and tell them that I'm in real estate, and what was the response? Oh,
yeah, the market's terrible.
Wow, how do you make any money doing that? And and literally it's been like that for several years now. So I mean that if consumers are starting to think that their money is safe in real estate again over the long haul, that's really going to help us.
I think the sentiment probably has a large part to do with what's happening. Like you mentioned, a lot of people got burned. You got a lot of people that lost thousands, tens of thousands, hundreds of thousands, millions on real estate.
Right.
I mean, they probably weren't in a real hurry to get back into the market after losing money like that.
Yeah, that's so true on residential too, Terry. I mean, the sentiment with the wife and husband and the new first-time home buyer. I mean, they're listening to the media. They're listening to to their peers. They're not listening to professional real estate investors. They're not watching the institutional markets. They're not in touch with what's happening from the investment side. And so, that media sentiment has to do a lot with what happens.
Absolutely, I couldn't agree more. And I mean, someone like yourself has been actively involved in real estate. You know, during the crash, you stayed in the market and stayed in the market, and you were able to make it work. So there are strategies that were effective, even in a declining market.
Absolutely.
So, and getting into the market watch here, home prices increased in 92 of the country's 100 largest metro areas, and this is a 2012 number. Okay. 23% in Phoenix.
Yeah.
Yeah, and 17% in San Francisco. It's kind of funny when you look at those two cities. I mean, those were two areas that were devastated a little bit with the crash.
Absolutely.
As far as declining values, you know, San Francisco, I guess you can understand it a little bit because as far as geographically, it's so limited.
Mm-hmm.
There's such a limited amount of real estate in San Francisco. You know, Phoenix, I mean, they got hammered.
That was the deal with Phoenix, is I think it really was that bad in that market. They just got hit so hard.
So many foreclosures, so many short sales.
The bottom was so low that they could really only go up. And you have to figure that there was a lot of investors entering those types of markets that were beat down so much. Investors are putting money into real estate because it's all on sale. And, you know, it makes perfect sense, and that is definitely a factor that's leading towards a recovery.
That 23% is amazing. So good for homeowners in Phoenix that were able to make it work and hang on to their properties. This is something that we really found important. 2013 and 2014 are going to be transition years. The market is improving, but it's not totally healed. And, you know, quite honestly, we couldn't agree with that more.
They're saying that there's going to be about 3 times the foreclosures in 2013 compared to 2012. Right now, there is a definite shortage in inventory in the housing market, partly because people don't want to sell. In some cases, people can't sell. There's a lot of builders out there that are out of business. Even the builders that are building are not building as much as they did back in the heyday. So the point is, we're really underbuilding as a country right now. So there's a lot of, you know, pent-up demand, so to say, as far as buying real estate. And I guess, you know, the big servicing companies, the banks, the government, et cetera, they feel that, you know, unleashing these foreclosures on the market is going to help with that demand. I don't know.
Kind of remains to be seen.
Remains to be seen. Is it going to help with the demand, or is it going to keep prices low?
But that's, you know, that's what we've seen, just as we get into some of these statistics here, that, you know, the prices have really, really got beat down over the last couple of years. And, you know, thankfully, you know, as you can see on this first stat, 6.3% increase in U.S. home values in 2012, expected to rise 5.6% in 2013. So that's, I will take it, right?
No doubt about it. We're not seeing the double-digit increases that we did, but the slow and steady growth is something that is really going to help us.
18 consecutive months that year-over-year home sales have increased. So, I mean, that's another really good stat. We're seeing more sales in the market. Probably a lot of people are taking advantage of the low interest rates, obviously. A lot of people are trying to take advantage of the fact that the properties, you know, the prices are so beat down right now, which we completely understand.
And we're seeing that, you know, really in the move-up market too. You know, where if you get a home that's, you know, a bigger home, a 4-bedroom home, whatever the case is, that's a little bit more expensive, not so much a first-time buyer home, those homes really seem to be going quick right now. And I guess the idea is that people can buy them cheap and they can finance them cheap. So if they can buy them, now's the time to do it.
And anybody that, you know, that watches what's going on with the real estate market or listens to us, you know, as far as on our presentations, know that rents are going up. You know, so it's a great time for buyers to take advantage of the market right now, and we see that a lot of people are starting to do that finally. $180,000, that's the median home price in December 2012 versus $221,000 in 2006. So wow, that's, you know, a $40,000 decrease in the median price of a home. That's pretty amazing.
It really is, but when you look back at the money that was being flushed through the real estate market back then, I mean, it really was funny money to begin with, right?
True. $87,000 average equity per homeowner in 2011, and that's up to $170,000. Or I'm sorry, down from $170,000 in 2006. So we still see that big hit in, you know, average equity the homeowners have in their homes, and unfortunately, you know, we're still seeing about a third of the homeowners out there that are still underwater. You know, meaning that they can't sell without bringing money to the closing table. But I mean, my goodness, for several years, it was almost, just on a local market here in the St. Louis area, we were seeing about 50% of all the sales either being short or people were bringing money to close. And that's obviously something, that's a very devastating thing for the housing market. Some people just can't afford to do it, and then they walk, and then you have the foreclosures and everything that happens. So good news that the prices are starting to creep up a little bit, although that we do think it's going to be slow and steady. 31% of renters expect to buy within the next 2 years, up from 22% in 2011.
You see some of that, better sentiment starting to come back in the market. I guess the caveat here is that obtaining a mortgage is still difficult.
It is. And we talked about this quite a bit. Back when the crash happened, they were even talking about it being a renter nation. You remember that term, renter nation?
I do.
Whenever, all these people, there were people actually choosing to go rent a home because they were either scared to buy or couldn't buy.
Sure.
And that number of renters are still, it's still going up. I mean, the rental market, we don't really know a lot about other areas, but we do know about the rental market in the St. Louis area, and it's still really hot. You have a nice property out there. I had one that I rented out in St. Louis County last week, and it was a nice home. It wasn't a cheap asking price for the rent. It was a top asking price for the rent, almost $900 for a 3-bedroom, and it went right away.
People crawling all over.
I had dozens and dozens of inquiries on it. So we really still see that rental market is very strong, and that's something that we probably we think is going to continue. 75% of sellers think their home is worth more than their agent's recommended listing price.
Oh,
that's not a shocker, is it?
No surprise there.
And I don't know if that number's ever changed, but people are just they're having a rough time swallowing the pill that well, I paid $400,000 for this house. Why is it worth $320,000 now? And I can understand that. It's a lot of money.
No, it stinks, but it's reality. People that bought homes back in 05, 06, 07, in a lot of cases, unfortunately, they took a bath on them.
And and the way that everything has turned out is a lot of times the only borrowers that are getting relief are borrowers that have some type of distress situation.
Hardship.
They have some type of hardship. The people that are out there working hard, paying their bills, they're getting nothing.
If you can afford to keep on paying, they're not going to help you. Which is not really the way that it should be, but it's the way that
it's the way that it is. Yeah, exactly. Okay. So the big picture is the nationwide real estate recovery is for real, thanks to low prices and historically low interest rates. Lately, 3.6% for a 30-year loan, which is pretty amazing. I know FHA was 3.5% a couple weeks back, which is
pretty good rate.
Holy cow, that's nice. Homes are more affordable than they've been in 40 years. Result, sales are moving up again. I actually saw a stat that I can't remember where I saw it, but it said that affordability, you can actually afford, and this, it made me think of it because it said that they've been more affordable than they've been in 40 years versus what people paid in interest rates in the 70s, versus what they pay now. Actually the affordability index is actually better now.
Unbelievable.
Yes, you can afford a more expensive home at this point versus what you would pay for the same home in 1970. That's pretty amazing, isn't it?
It really is.
And we see that the projected what they're projecting for the recovery is it's good. It's going up. It's back in the black again. And then obviously starting in 2005 when everything started going down, that huge dip, and it's going to be a slow and steady recovery.
This is good, really good information, but you do have to step back a minute and think about it being a transition market, where it's not a market again where a seller is going to be able to put their property in the market and get flooded with contracts typically.
Right.
It's not really a buyer's market anymore as much as it was, but it's definitely not necessarily a seller's market yet.
You have more buyers that are coming off the fence. You have low inventory, okay, at this point. Until something starts happening with all these foreclosures that are sitting out there, at this point you have a low inventory. So that's really what's causing, the market to heat up, where buyers are getting a little bit more aggressive, actually a lot more aggressive than they have been.
Right.
And that's a positive for sellers, but like you said, it's still not a seller's market by any means. Plenty of room for improvement, and this kind of goes back to what we have been talking about. It says the housing revival is far from over. That's the forecast of Trulia's housing barometer, which measures the market's health based on construction starts, existing home sales, troubled mortgages. On a scale of 0 to 100, they're at 31%. And how they get this 31%, we couldn't tell you for sure. That's for the economists. But what this is saying is, according to Trulia, and they obviously have all kinds of data to look at, they're saying we're 31% of being a healthy market. And what they consider a healthy market, 100% market is the normal pre-bubble activity. So hopefully we're well on our way to that 100%.
We want to see that rise, and we think that it probably will, but it's going to be a slow process.
Definitely.
Now, are you sure they didn't pull that 31% out of the hat?
They might have. Who knows how they got that, but we're counting on the experts at Trulia for that 31%.
No, definitely. It's and it's probably on par. I mean, all the comments that you just went through based on, I mean, the amount of homes still underwater, I mean, the amount of foreclosures, I mean, the shadow inventory, which is basically what's happening, and it's interesting, what's going to happen this year, what they're predicting this year based, from what happened last year.
I really think shadow inventory is still the elephant in the room, whenever you're talking about the real estate market. And the thing that's crazy about the shadow inventory, nobody really knows how many homes, units it really is.
They estimate 3 million. 3 million homeowners that are, essentially not paying their mortgage. I mean, many people are facing either a short sale, a foreclosure, or deed in lieu. That's their three options.
Plus the foreclosures they already have, plus the homes that they're trying to foreclose on. I mean, there's a bunch of inventory out there still that the American public's going to have to sift through.
Absolutely, and that's going to take its toll on the real estate market. It doesn't necessarily mean that it's going to destroy the market like it did before. It probably won't, because I think they're better suited to handle it. At least they think they are.
I agree, but I do think in some cases, specifically in some areas that were hit harder by foreclosures, I think that it will continue to drag the prices down. I really do over the next couple of years. So that's going to be a little troublesome.
Absolutely. So that's it for our Market Watch. We want to let everybody know out there that we're going to be we'll do another webinar on this information and expand a little bit. We want to go through some more of the stats that was provided by Money Magazine. They have some really poignant stuff on insurance. That's a big thing right now, right?
It is.
Insurance carriers
insurance premiums are going up.
So I mean, if you have real estate and you have, obviously you're going to have insurance policy. I mean, this is all stuff that you need to know. There's some good information from sellers. There's some good information from buyers. So we're going to be expanding on this information in our next webinar. But now we're going to turn it over and do some Q&A with Chris Winterhalter, and who we've been working with for years and years. And Chris has really done a great job. He's done some awesome projects in St. Louis.
High-level stuff here in St. Louis. Seen a lot of success and seen success in a down market, which is very impressive.
And I mean, and Chris, you can let us know on this. I mean, it hasn't been easy, right? I mean, it's not, making money in real estate is not like you get on your internet and you write a contract on a house and then you make 30 grand. It's not as easy as people make it sound.
And then the computer just starts printing money out.
Is that how it works? I got to get that software.
Exactly. You can get it from your, the late night television guy. He'll sell it to you.
Gurus. We love the gurus.
Yeah, every promoter out there. It's not easy by any means. It's very difficult, and it's just like any other business that you start. And we've seen a lot of challenges over the last 5 years, obviously, but there's been a lot of different niches that have come from this down market. And there's been a lot of money that's been made, and it's just a different mentality and a different different aspects and avenues that you have to take to make that money.
And that's we're really excited to have Chris for that reason, because Chris he's actually a businessman, right? Okay, he actually buys, he actually sells, he actually rehabs properties.
How many projects have you been involved with in St. Louis, Chris? Did you keep a count?
Well, I've purchased and developed almost right over $3.5 million worth of real estate.
Wow.
And it's been in probably over 30 properties, give or take.
So you've been, just getting into these questions, how long you been involved in real estate, Chris?
So right during the crash, so right in 2008, so not quite 5 years. I started because I had an interest in real estate, and maybe like a lot of people that are listening right now or listening to the podcast, and I just basically started learning. I knew nothing about real estate come maybe, let's call it 6 years ago, and just dove right in and put a plan together. And that plan didn't go as planned, and put another plan together. and made things happen and fought with it every day nonstop, and was able to make a run of it. And it's been a great 5 years. I've learned a ton, and I've done a lot of different types of transactions. I've learned, what I personally like, and what I want to do for the future, and just learned how to lose money in this market and learned how to make money in the market. So it's been interesting.
So you're involved in multifamilies, Chris. We know that, and we've done some deals on some bigger buildings. How many doors do you guys currently have right now in St. Louis?
St. Louis, we have 55, and that could hopefully rapidly increase. Across my business partners and I, we have 74 units across all of us.
Okay. So what do you see? I mean, what drew you to multifamilies in particular?
I love the economies of scale. I started out doing single-family projects, and with every project, you have a different scope of work. For if you're going to do renovation, you have a different executive summary, a different business plan, more or less. Even if it's a small project, you don't call it a business plan. You have a business plan for that property, and what's it going to do? What are you going to change in it? How is it going to perform? And your long-term strategy, your exit strategy, and so multifamilies. I learned through doing single families that the scalability of single families for me personally, caps. So you can do many more projects for multifamilies and have a much larger economies of scale. And possibly, it's interesting what's actually happening with the institutional investors that are starting to invest in properties. And starting of, I think, last year, the first publicly traded REIT was formed with the sole purpose to purchase single-family properties. Blackstone just closed on a $2 billion fund to buy single families. Since 2012, they've had $3.5 billion in funds to buy 20,000 single-family properties.
Wow.
Obviously, they're smarter than I am, but I have a different philosophy than they do, and I still believe that the single-family avenue is more difficult to scale than the multifamilies.
Well, it's just what works for a particular business. I mean, that's the most important thing. I mean, buying single families on that scale, it's hard for me to understand how that's going to work, to be honest.
Yeah.
Terry,
well,
obviously,
they're taking a different approach than the little guy would. I mean, if you can go out there and you can buy 10, 20 properties all at once, I mean, obviously it's going to be a little bit different than someone that's buying one.
Yeah, but I think I agree with you, Terry. I'm curious to see how it's going to work. Not to get off on a tangent point about the institutional investors, but I'm curious to see how it's going to work. I mean, they're playing off of the appreciation aspect. They think they're going to cash out big, which maybe they will, in 3, 5, 7 years. So
they better have some good managers on the ground.
Exactly.
In the meantime, in my opinion, because I mean those, the single families, not that they're impossible to manage, but there's a lot of issues.
Exactly.
No doubt.
I mean, personally, if I had to do 10 single-family houses and one 10-unit building, it would probably take me 9 times as long to do the single-family properties as it would the 10-unit building. And so, personal preference, my personal investment philosophy, and that's what we decided to pursue, and that's what I'm deciding to pursue in the future.
No, that totally makes sense, Chris. So St. Louis in particular is a good market for investors. It has been historically, and this is something that we'd like you to talk about. So what drew you particularly to the St. Louis market, Chris?
Well, I mean, it's obviously the gateway to the West. It's a great hub and great center of our country. There's strong cash flows, very strong cash flows in the city, the county, and there's a solid diversity of employers there in big business, and that's really the strong indicator on what will stay strong and stable in that economy. I also weirdly I love the availability of solid brick buildings. I mean, St. Louis, St. Louis City has a ton of just solid brick buildings, and I think it came from, there was a fire, I think, in like 1850 or something.
Mm-hmm. Right at the turn of the century, from what I understand.
Yeah, and then the city mandated that all new construction be brick or stone. And because of that, let's say 100 plus years later, we're reaping the rewards of that. And these 80, 90, 100-year-old buildings, if you pick them up right, you rehab them properly. I mean, these things aren't going anywhere for another 100 years.
Yeah, that kind of goes into our next question, and you're right, Chris. There's just a ton of brick in St. Louis, and they're really awesome buildings. So just if you could expand on that, I mean, what really drew you to rehabbing historical properties?
Well, I'll take a little bit of a step back. So we've done a lot of multifamily projects, but we've done a lot of historic properties, both multifamilies and single families, and the background of my business and my business partners has really had an emphasis on construction. I mean, rehab and development, redevelopment has been a big part of our competitive advantage for our company, and it's really given us an edge to other companies. We've tackled projects that scare a lot of people, scare a lot of investors. I mean, I've used a structural engineer many times on projects, which most people, would look at a wall, exterior brick wall falling down, or
Yeah, and they would walk. Right.
And they would walk. And we've done interesting things with mold remediation and just water damage, and fires, and it's been through that there's been a lot of older buildings, a lot of historic buildings that have needed rehab, and so that's been a part of why we've gravitated toward historical properties. Another, from a personal standpoint, I mean, I just love the historic buildings, the old brownstones, the brick. I love the design. I love the way that it was built, the hardwoods, the details, the stone details. I mean, we couldn't replicate these buildings, I mean, for 25% the cost of what it would take to rebuild these things. I mean, it wouldn't be possible. The stone details alone would cost, 50 grand to do, just in, some of the little details that are involved in these buildings. And another aspect is, there's some good incentives. So we always go after tax abatements on any historic project that we've done. Sometimes state tax credits. It's interesting. I have a kind of a good strategy what I do when I come in and rehab a building. I'll go in, I'll immediately do a tax appeal on the building, because more than likely if we buy something, the taxes are way out of whack. And so we'll go in, we work with a lawyer, she takes 50% of whatever she gets us, and she goes in, she files a tax appeal. And then while we're doing the rehab, we'll file a tax abatement. And so while the two are working simultaneously, the key is to get a tax appeal and a tax abatement completed at the same time. So you get a new tax appeal, low tax base, and then you get a tax abatement approved on that tax base. So that's been, I mean, that saved us a ton of money. I had a property, the taxes were almost $5,000 a year, and we appealed it down to like $1,200, and then we had a 10-year tax abatement at the $1,200 a year.
And that tax abatement is something that you can pass along whenever you sell it, right?
Right.
Of course. So, I mean, anybody can do the math there on, what you save per year. I mean, that's, almost 30 grand. And so it's, those little things have also really made it appealing to do these projects as well.
Well, if you do your research, like Chris does, I mean, it's, you can find ways to make these buildings work, and be more profitable, which is fantastic. Kind of changing what we're talking about a little bit here, and Chris, we talked about this earlier, and you've done flips, wholesaling, rental property. I mean, do you prefer one from the other, or combination of all? Do you feel like that's a better way to go?
I think well, I mean, it depends, where you're starting, what your investment philosophy is. But I'll comment on, it's really interesting how wholesaling works with buying rental property or doing flips. And so I'm a firm believer in wholesaling is not an easy business by any means. It's a difficult business. You have to be really good at sales and marketing. You have to know your values. I mean, you have to know your values almost better than if you're, a really good landlord. And you have to, you always have to know your values, but wholesaling to the T. And but with wholesaling, you're constantly generating leads, and so you always have a deal flow from that you can fill your rental property or your flips. So I think that wholesaling is a great complement to either one of those. What I prefer, I'll touch base with, later down the line, but right now I prefer multifamilies, being a landlord of multifamilies and wholesaling.
Let me ask you this, Chris, because this is something that I hear actually, and I know the answer to it, and I know you do too. But back to wholesaling, unfortunately, I think there's a ton of misinformation out there when it comes to wholesaling. People make it sound real easy. So let me ask you this, Chris. If you buy, let's say an REO property, a HUD-owned property, does the seller allow you to assign that contract while you're in escrow?
Absolutely not. Absolutely.
Yeah, exactly. And that's something that I hear people teaching investors to do.
It's ridiculous.
Yeah.
I think the one thing that really stinks about wholesaling is, it's very appealing because
Sure.
people are thinking, well, I don't have to put a whole lot of my own capital into it. I don't have to put a whole lot of time into it, and I can make this easy money. And so what happens is you have these quote-unquote experts out there packaging these slick marketing systems that they in turn sell to people that don't work.
Right.
And then a lot of times people are stuck with a property that they don't have the money to fix up, so it sits there vacant, losing value, and it really can turn ugly. So if you're thinking about getting into real estate and someone's telling you how great wholesaling is, maybe it'd be a good idea to take a step back and get a little bit more information before you buy their $500 system.
Exactly.
Yeah, I completely agree. I mean, wholesaling it's a great business, and the wholesalers that I know that do a really good job are very experienced. And I tell you what, you put a lot of cash into marketing. You put a lot of money into marketing. You need cash available to buy properties. I mean, I've done a lot of wholesaling, and I mean, I generally never assigned a contract. One, because there's a little bit of a misconception when you assign a contract. Obviously, it's legal, but you want to make sure that there's no issues with the seller. So what I always did was I did a double close. So we would do an ABC transaction, and at the closing table, the title company would deal with it. We would buy it the same day and sell it the same day, and there would be no assignment issues that can sometimes happen.
Yeah, that's a good point. And I know that I'm just thinking of deals that we've done together, Chris, and I know we've done at least one assignment, but it was fully disclosed to the seller. There was a reason for the assignment. So anytime you're talking about signing a contract, even though it is legal, if the seller catches wind of it, it's going to upset them.
And if it's a bank-owned property, it's not going to happen.
It's just not allowed. So.
Yeah, exactly.
So how about your most successful transaction in St. Louis, if there is one? I mean, I know being in this business, it's never about one transaction. It's about having a good plan and having a lot of transactions that do well, not necessarily have one that you hit a home run. But if you had to pick one out that was maybe your most successful, or maybe even just your favorite one, the most fun that you had during rehabbing a house or whatever, what would that be, Chris?
Yeah, I mean, obviously I've been a part of a lot of great transactions, a lot of base hits, a lot of doubles, almost baseball season, so we have to, bring in some analogies there.
Yeah, do we want to talk about the Cardinals?
We could. We could save that for another webinar,
Yeah, we should. We should.
And I've been a part of a lot of transactions, quite a few transactions that haven't been that great and been very, very challenging. But there was a really cool transaction that I was a part of. It was one of one of the first very, very large historic flips that I did, and it was a huge, beautiful property in Compton Heights. It was a 3,500 square foot property. It was a 3-family that was converted that we did into a single-family property. We fully restored it. We put over $200,000 into the property, and it just turned out phenomenal. It was a great project. We had multiple offers in 3 days, I think.
Yeah, that's amazing. And I remember the house. It was a gorgeous house, no doubt. And to have multiple offers, particularly on a house, like that, is pretty amazing. And particularly in a down market as well. So that was an awesome, awesome house. I remember that.
And I remember, all the neighbors loved me. The high comp on the street was $100,000 under what we sold it for. So, I got invited to, events and barbecues. It was pretty funny. But weirdly so, that probably wasn't the most successful transaction. There was a deal, actually a wholesale deal, that I did with Terry. It was weirdly so, because it's not a case like this, but it was a property I was going to buy, and it was owned by a builder, and he built it. It was 2010 or 2011. Obviously, new home construction was down and still is, and so he could barely stay alive, and we hammered him. We put a low offer in for, it was probably 6 months, and we just kept throwing it out there. We're here, don't worry. First they just told us to take a flying leap, and then slowly keep throwing it at them, and eventually they accepted it. And it was a local bank, I believe, had the note, and it was a short sale, but it wasn't a short sale in the sense that it was a residential loan. It was a commercial loan. The bank told them they'd take a reduction, and so we had it all worked out. It was a good deal, and I ended up not buying the property, and I wholesaled it, and I think we made over 20 grand on the wholesale. And it's I didn't have any dollars in marketing other than my relationship with Terry, and the fact that we had a program in place to submit offers and just badger the hell out of sellers until we got what we wanted, or they just said no, and sold it to somebody else. So we didn't really have anything at all into the property, and so that was an easy deal. The historic property had many more hours involved in it of work.
I believe that. Yeah, and I remember both those, and that's kind of funny to compare one to the other, because it's really at the total opposite end of the spectrum. Okay, so this is important, Chris. You actually you travel a lot with what you do with your job and your life, and you have to kind of count on different type of professionals to help you, to assist you in your rehabs and your management. So can you talk a little bit about what type of professionals that you utilize in your business?
Yeah, definitely. The list, as you know, is ever endless. But I think first and foremost, you have to have a really good accountant and bookkeeper. And if you're going to be your own bookkeeper, then fine. But you have to be really diligent at it. And I find that more times than not, most people do not keep up with it, especially if they're, let's say you're not a full-time investor and you work, you're investing on the side. Well, you invest on the side. Let's say you have a family, you have a full-time job. You have just enough time to try to invest in properties. You don't have enough time to handle your books, and so generally it won't get done. So I was the same way when I first started out. I tried to handle the books myself. I said I was going to stay on top of it, and it never happened. And it can cost you. You have to be 100% completely on top of your numbers. If you don't know your numbers, it can just be the complete death of you and your business. And so a really good detailed bookkeeper and accountant is worth their weight in gold, definitely. So that's number one recommendation. I mean, on our team, we have tons of contractors that we utilize. I mean, tons of different subcontractors and electricians and general contractors and plumbers and landscapers and, I mean, HVAC contractors, and the list goes on and on and on. And those are very valuable to have. One of our closest partners, because of what we do, is our property manager. They are just, I mean, they help us immensely. They're a huge partner in our business for what we do. They manage all the tenants and toilets, and we are able to continue to develop property to give them. And so you need a really good property manager if you want to be a landlord. And if you're starting out and you just want to buy 1 or 2 or 3 single families and you want to manage them yourselves, then fine. But I can tell you that the 10% that you're going to pay to the property manager is going to be so much more worth your time than trying to do it yourself. Unless you really have a huge interest in working with tenants and leasing properties and handling maintenance calls. That's not me. I don't want to meet my tenants. Nothing against them, but I don't want to be involved in what goes on in their life and why this isn't working, or calling the handyman. That's not what I personally want for me or my business. But I would say the 10% that you're going to pay for them, and that obviously fluctuates, is going to be worth its weight in gold. A really good real estate agent is super important. Obviously, you heard my story between Terry and I of that wholesale deal. I mean, the relationship that we've built that has just been, I mean, it's been great, and there's been just countless of money made just because of that relationship. And you really need to be diligent on who you're picking for, any of the team members. But the people that are going to hand you your deal flow is very important. And the people that are going to, unload your deal flow to sell, it's very important as well. So you need to be very thorough in making those choices. Insurance agents a good insurance agent is very important. I've been through probably 8 insurance claims since I started, and 2 6-figure claims. And I can tell you that having a really good insurance agent to help fight for you and to help describe before he sells you the insurance what the insurance policy is, what it entails, what it's going to cover, is very important, because you learn very quickly what your policy states when you have a loss. And when you don't have loss of rent insurance, or you don't have a specific rider or this or that, you think, well, I didn't know that when I bought insurance. Why didn't my insurance agent tell me that? And it's happened to me, but I would imagine it happens a lot. Especially in this industry, especially when you get into properties besides single-family properties, besides 1 to 4 unit properties, you start to get into different commercial lines of insurance. It can become much more complicated. I don't want to go down the line, but lenders is another point I want to touch on. Just super important. Obviously, you need the funds to be able to grow your business. You need different types of funds. If you need short-term funds for construction and acquisition, you need long-term funds. So you need to create relationships with conventional lenders. And if you're going to get involved in any type of commercial real estate or any multifamilies, 5+ units, you need to have those relationships with local and regional banks as well. And especially because what was pointed out, if you have the right relationships, the right banks, you know what interest rates are out there. That can be very important as well to make your deals make sense from a financing standpoint.
Yeah, that's certainly good advice. And I know that you could continue to talk on this, Chris, but for the matter of a time constraint, we'll move on to the next slide, and just give you an opportunity to talk about any advice you would give to a new investor.
Any advice to a new investor? That's a great question. Learn as much as you definitely can, but you also
Don't listen to late night TV.
don't listen to late night TV at all. No, get educated as much as you can with people that are actually out there doing the work. People that own properties, real estate professionals, people that that are in the trenches, doing it, and talk to people that are active in this market, because this market is quite a bit differently. I think it's funny, there's all these promoters out there and gurus, and they, I think maybe they had some success in the boom, which I think anybody could, and then all of a sudden they, they're some, quote unquote expert. And more than likely, they probably made all of their money since the crash on, selling material or selling courses, which is sad. So.
And unfortunately, they're selling systems that might have worked, back in 2003 or 2004, but they simply just don't work in today's market, and they haven't worked. And we see it unfortunately a lot.
There's no doubt. We always tell people that it's a good idea to work with people that are licensed.
Right.
People that do it for a living, just exactly what Chris just mentioned, someone that has bought and sold investment properties before. And something else is we always when getting into buying investment property, building a team and interviewing the right people for a new investor is very, very important. It's paramount.
It's key, definitely. So.
Yeah, it's definitely key. And real quick, I would definitely recommend for a new investor to pick a niche and to stick to it. Build a plan, set specific goals, and take action. And don't put themselves in a situation where they can't get out of, especially for the first couple deals.
That totally makes sense. You got to have a backup plan, right?
Have to, and you don't want to put your life or family or whatever your circumstances at risk 100%. I mean, you definitely any business, any real estate investment. There's certain risks to it, and you have to take action at some point. And what? I've failed on projects. I mean, Terry and Keith, I'm sure you've had failures on your end. It's a part of business, and it happens. But you don't want to set yourself up for large failure from the very start that you can't dig yourself out of.
I think you have to have enough capital going in too. I think that's something that's very important for someone that is getting into the business. I know if I sit down with someone and the first thing they say is, well, I want to do a couple deals so I can get some capital. It's like that's like a big turnoff from the get-go. You got to have some money to get into this business. I mean, you're buying investments. It's not like playing Monopoly. I mean, you really have to have enough money behind you to get through these deals.
That's a good point.
That sounds a little backwards, Keith.
Yeah, exactly. Maybe I should go on late night TV.
You should.
So what about plans for the future of sustainable ventures?
That's a great question. I believe I'll continue building a rental portfolio of multifamilies in St. Louis, but I also have I was born and raised in Cincinnati, Ohio, and I have plans to at some point move back there, transition my business there, and basically do more or less what I do now, and but on a larger scale. I'd like to handle larger multifamily projects. I would also like to do historic loft conversions in the downtown area. So those are the new plans I'm working on currently, and I'm definitely excited about the historic loft conversions. I like the scalability of the multiple units in a building from the sales side, from the rehab sales side, and the aspect of getting back into the historic rehab flips.
No, that sounds great. That sounds great, and you kind of answered this last question already. So we'll wrap up. We're getting close to an hour. We generally like to try to keep it under an hour. Again, this presentation can be downloaded on iTunes for anybody that's a member of the iTunes store, and also we'll have it on YouTube probably within the next day or so. So anybody out there listening, if you want to share, please do, or listen again. And Chris, we really can't thank you enough for taking the time to present with us tonight. I mean, the information that you provided is just great advice for anybody that's interested in real estate. And, Chris has really done a fantastic job. One of our best clients that we worked with in our career. So we just really appreciate you taking the time tonight, Chris.
No, I definitely appreciate being on the call, Terry and Keith. And, yeah, it's been great.
Real good. So we'll go ahead and wrap up. Everybody, thanks for taking the time to listen to our presentation tonight. Look for our up-and-coming webinars and podcasts. Have a good night.
Good night.